Well, hello. My name is Anthony Sicaro, founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also an estate planning attorney and host of the Providence Financial Retirement Show, which airs every Saturday on AM 870. KRL lays the answer. And periodically, I like to do economic updates for my clients and let you know how what's going on out there affects your portfolios. So there are quite a few things that I want to hit on in this video. First thing is the presidency and what that means for you and your investment with us. I want to talk a little bit about coronavirus as well, too. Also want to hit on yields and talk about what's going on with that. That's important. It'll be a very important conversation for you who are clients of ours. Also want to talk about some changes we're making to your portfolios and then give you an option if you decide that maybe you want to be a little more aggressive. A lot of you have asked me about that, so we're going to spend some time talking about that too. So it's those 5 things that are on the agenda for this video. And if you're not a client of ours, feel free to check us out, providencefinancialinc.com. If you have any questions about anything that you see in this video, just call me, let me know, we'll schedule a quick call. I'd love to talk to you. So let's talk about the presidency. The reality is that I'm recording this video on Tuesday, November 10th. I'm probably not going to release it till Friday. The consensus across the board is that Biden's going to be president, although in all fairness, there's a lot of legal challenges going on. I think Trump has an uphill battle, so I don't think that's going to go anywhere, but I think we still don't know 100% that that's going to be the case. Same thing with the Senate. It looks like the Republicans have held on to the Senate, but I think we don't know 100% that that's the case. I think it just looks like the odds are in the Republican favor, and I think there's still some outstanding states that have yet to finalize. But what does that mean for you? A Democratic president, Joe Biden, and a Republican Senate? Well, the market went up dramatically as a result of what they thought were going to be the election results. And the reason is because there was not a blue sweep. Had there been a blue sweep, I think we would have seen much different results, because then Biden could have taken his aggressive agenda and he could have put it forth with a Democratic-controlled Congress. But because the Senates are still Republican, Biden's going to be very much tempered on what he can actually do. So I think that's the reason that the market went through the roof. The market doesn't like too much control in one party. It likes diversification. It likes that checks and balances. And so the market really liked that. Now, that was kind of odd. We didn't know, that it was going to be that way. Everyone was really expecting a blue sweep. And there were smart people that several months ago were predicting that if Biden got elected, then the very next day the market would go down as much as, I heard, 25 and 30%. Well, obviously that didn't happen. So, and there's 2 points, 2 aggressive points that Biden really wanted to implement. One of those was taxes, and one of those is more funding, more stimulus. So let's talk taxes. Had there been a blue sweep, taxes would have gone up probably fairly quickly. And of course, in the middle of a coronavirus, that it would not be good. The stock market would realize that that would not be good. And I think really with the blue sweep, we would have had a much different stock market outlook than what's actually happened. Even if he can push through some higher taxes, he still has to deal with a Republican Senate, and that's going to be tempered to some degree. So it doesn't mean taxes aren't going to go up, but he wanted to take the corporate rate from 23% to 28%. And that could have happened pretty quickly with the blue sweep, but now I think there's a question of whether that happens at all. And if it does happen, it's going to require bipartisan support, much more communication and conversation, and now it's going to take a while. And the market tends to be looking short term. So that's not something that's going to happen in the short term. It may be a year or 2 before that happens, and the market's not looking out that far. So it's not something that the market's considering. Now, when it gets closer to that point, it's probably not going to be good on the market when that happens, but the market likes to digest things, and it depends on how they put it out and to what degree they're going to raise taxes and so on as to what impact we're going to have. But I don't think the market's looking that far out now. The other thing has to do with stimulus. There's supposed to be another stimulus package that they've been talking about for a couple months, and I think the primary reason why they haven't done that probably had to do with the election, because they couldn't make an agreement. And with the blue sweep, the Democrats really wanted to put out more stimulus more than the Republicans. And in the short run, that's great for the market. In the long run, it's not so good for the country. The fact that we've just gone from a $4.1 trillion balance sheet in February to $7.1 trillion. Someone's got to pay that back. And I'm not saying they shouldn't have done it. There's lots of businesses that are in business today because of the stimulus that they've done. But they couldn't come to an agreement before the election of how much stimulus they want to do. And it looks like that's going to be tempered as well. Again, with the blue sweep, they could have done a lot more stimulus than they wanted to do. They were talking about $2 or $3 trillion, and now I don't think they'll be able to do that amount. But we know more stimulus is coming. We just don't know to what degree. But the market likes that. So the fact that Biden's tax agenda is going to be tempered to some degree and really pushed out even further, and the fact that we know the stimulus is coming, but we don't know to what degree, all of that's good for the market. So the market, as a result, has just done well as a result of the election. Not to mention the fact that I think just people are relieved, and I think it's time to move on. And I think that has a lot to do with it, too. People are just feeling better and therefore more positive and optimistic, and then buying stocks. COVID, topic number 2, and very similar related because there's stimulus that's going to come out as a result of COVID. But the reality is, in the last couple of days, market has gone through the roof. Yesterday was up a couple of percent, the Dow Jones, simply because of the fact that Pfizer has announced that they have a vaccine. Now, I don't know about you. I don't want to get political. But it's kind of ironic that Pfizer announced a vaccine that, within a week after the country has recognized Biden as president. It was 3 weeks ago when they had, or 4 weeks ago when they had the final debate, and Trump stood up there and basically said, in 3 weeks we'll have a vaccine. In 3 weeks. And Biden criticized him, and here we are. And I've joked with a lot of you, and a lot of you have joked with me about the fact that, coronavirus goes away the day after the election. And I kind of find it funny that Pfizer has come out with this vaccine really just within a week after. Did they know about it? Did it just get I don't know. Again, I don't want to get political. I find that humorous. It doesn't really matter at this point. But as a result, the market went through the roof. Now, we got to be careful, though. Okay, the reason we have to be careful is because they've limited the number of how many people are going to get it towards the end of the year. They've limited the number of how many people are going to get it in 2021. There's going to be a lot more. So there's still a lot of things that we don't know about it, but certainly looks good. They've been talking about a vaccine for a long time. Certainly looks good. So the market's on the rise as a result of that. And barring something just dramatic, barring something that's just devastating, like maybe it doesn't work. I mean, we don't know for sure it's going to work. I read recently that that coronavirus, they've learned recently that coronavirus will immunize you for only 3 months, and then you can get it again. Now, I'm not reporting on this. I don't know for sure that that's the case. But who knows then? Is the vaccine only going to be good for 3 months? We don't know. So there's still a ton that we don't know. And if negative news comes out, could ultimately affect the stock market as well, too. But for the last couple of days anyway, the market's gone through the roof because of the hope of this vaccine. So that's a second item I wanted to talk about, just a little bit about COVID. Third item, and a big item, is I want to talk about yield. We invest for income. You know that we invest for income. That's our focus. We've always been pro-income. We've never been anti-stock market. We've always been pro-income. Even in the stock market, something like 43% of the total return of the stock market over the last 20 years has come from dividends, from income. And I'm conservative. I like to play conservative. If we don't know, I'd rather err on the side of caution, because I don't want to be having conversations with you about why you can't make it through your retirement because we made a mistake. So I'd rather be too cautious than too aggressive. And that's the way that I've run my business. That's what, that's who we attract. Most of you would rather be too cautious than too aggressive as well, too. And yet we focus on income because most of you are retired and most of you need income. And we'd rather spend interest and dividends without having to sell shares than have to sell shares to get your income. Pretty simple conversations I've had with all of you at one point in time or another. For those of you that are a little bit younger, we have focused on income because it's still a good way to get 4.5-5% return yield without the risk of the market, or certainly without the full risk of the market. And so a lot of my younger clients would rather get 4 or 5% and not take the risk of the market and wait for a better time to get back in the market. But yields have gone down. You know that our target for years, probably for the last decade, has been 5%. That's our target, to get you as close to 5% as possible after all the fees, get you in the range of 5%. That's our target. Most of you are in the 4.5% to 5% range, that range right there. As far as your yield is concerned, if you're investing for income the way that we focus on income, then 4.5% to 5% after fees, that's our target. And yet, the Treasury, the 10-year Treasury has come down to hanging in the 0.8% range. That's 0.8%. And all of the yields, all of the bonds, the preferred stocks, the different investments that you have, any investments that where there's interest and dividends that are tied, that are producing yield, those are really all tied to the 10-year Treasury. That's kind of the benchmark. And it's almost like, if the 10-year Treasury walks across the street, then all the little duckies walk across the street following it. So it's all tied to that. Because it's come down so low, because there's been so much stimulus out there because of coronavirus, the fact is that rates across the board for corporate bonds, for preferred stocks, for everything have come down. And it's harder to get you closer to that 5% than it was just even 8 or 9 months ago before this virus. So what does that mean? It means that for our newer clients that we've taken on within the last 8 to 10 months, we might not get you to 5%. Okay, I think we're going to say 4 to 5%, and there's still a possibility we get closer on the 5% range, but I think we're probably focused more on the 4.5% range. Okay, 4.5 is probably going to be right where most of you are, maybe on the higher side, so maybe 4.5%. And we've had those conversations. If we've taken you on recently, then we've had the conversation about that. We're still trying to get you close to 5% as possible. And there's ways to do that. We're going to talk about that in a minute. But 4 to 5% is really going to be the norm with some of the changes we're going to talk about in a minute for new clients. What if you've been with us longer than a year? You've been fully invested longer than a year. Well, the nice thing about income-producing investments is a simple fact that when you buy a bond, when you buy a preferred stock, the value is going to fluctuate, but you're going to get that income coming in consistently and persistently, regardless of the fluctuation of the value. So your yields are still going to remain the same, and if you were getting 5% before all this started to happen, you're still going to get 5% now, except for one thing. And that is that what's happened is a lot of these investments are calling their investments. Some of the preferred stocks are being called. We've seen some of the bonds are being called. And what that means is that when they're called, then the bonds and the preferred stocks are gonna cash you out. And then now you have the cash, we have to reinvest. You don't have a choice on that. And we have to go reinvest it. And now when we go to reinvest it, we're reinvesting it at a lower rate. So it is possible, too, that you see your portfolios start to go down, the yields rather, not the portfolios really, but the yields start to go down just incrementally as investments get called, and then we have to reinvest. So I think it's important to understand that. So you might have been at 5%, and you might just incrementally start to get a little bit lower on yield, just because that's the environment. That's what's happening with all the investments out there. And this is one of those situations where you don't shoot the messenger. I'm just letting you know this is what's happening. So you might see that. So what can we do to change that? What can we do to get you closer to that 5%? Well, there's two things that we're doing that you need to be aware of. Do you remember a video that I put out maybe 4 months ago or so, where we talked specifically about business development companies, and because they had come down a lot in February, March during the market crash, I had told you that for our clients, we made a global decision, a decision for you guys across the boards, that we were going to liquidate half of the BDCs and wait for a better time to buy in. And the thought was that the BDCs might drop again. If we do have a Democratic election and the market does go down, then it's a better time to buy. So the reality is we put some cash on the sidelines waiting for what we thought might be a better time. And I talked with a lot of you individually about this, and I've never talked to one of you who has said, no, that was a wrong decision. Every single one of you that I've talked to personally has said, no, that's exactly what I would have done, based on the information that we have. So we We liquidated half of the BDCs. We left that as cash on the sideline, and you guys have had a little more cash in your portfolio than we normally like to have because we know or we want to wait until there's a better opportunity. Well, it looks like that better opportunity is not necessarily going to come. And we've kind of come to the conclusion that there's not a lot of red flags ahead. There's not a lot of things that are going to derail at this point, derail the stock market. The Federal Reserve has said that they're going to keep rates as low as possible. They're going to put more stimulus, no matter how bad the economy is. The reality is that with the stimulus, the stock market likes that. It's almost like cocaine to a cocaine addict. They like it. No matter, so the reality is that we just don't see a lot of red flags ahead with what's going on. So, and because yields have come down, and because we don't see a lot of red flags ahead, I have now authorized sound income strategies to go back and start buying some of these BDCs again. Generally, we're not going to see more than maybe 15% of your portfolios in BDCs, probably 15, 20 on the high side. Some of these BDCs are yielding 8, 9%. So what that means is that by going back in and reinvesting BDCs, you should see your yields start to go up just a little bit because we're going to reinvest. So if we have a total of 15% of your portfolios roughly in BDCs, well, for the last 3 or 4 months, you've only had maybe 7% in BDCs. So by the time we add the additional BDCs, you're going to see a little bump in your yield. So that's something that we're doing to combat the yield and still not take a lot of additional risk, but try to keep that yield as close to 5% as possible. Another thing we're doing is we're adding REITs back into the portfolios. You might remember, really, it's been a couple of years since we pulled REITs out of the portfolios. REITs are real estate investment trusts. And the reason we pulled them out is because the Shiller Index, which is the real estate measure, that Shiller Index is higher than it was before 2007, before the subprime mortgage debacle. And real estate right now is just valued very high. And we've thought for a year and a half or two that it couldn't just stay at this level, and that REITs really kind of became dangerous because of the simple fact that real estate was at record highs. And yet, what's happened is with coronavirus, it's changed the type of REITs that we would think about investing in. But because of so much stimulus, because interest rates are so low, the demand for property is through the roof. Anyone that's trying to sell a property today is getting rid of it within a matter of hours. And so real estate doesn't look as dangerous as it did even just a year or two ago. So we're actually starting to implement REITs back into our clients' portfolios. And a lot of these REITs are yielding between 5 and 7%. So that as well, if you get REITs back in your portfolio, it's going to cause your portfolio the yield to go up a little bit. So we're adding these things back in an effort to try to keep you in that 4.5% to 5% range. So we're doing everything we can to keep you there as far as your income's concerned. Now, it doesn't mean that we're going to make this change for all of you. I don't want to give you all the wrong impression. It doesn't mean you're all going to have REITs in your portfolio. This is all portfolio by portfolio basis. I'm going to be personally involved in looking at portfolios, dealing with sound income strategies as well, authorizing some of this. I'm the general contractor. You've hired us to build your home, but I'm not the one doing the framing, the electrical, the landscaping. Those are the subcontractors. And that's really where sound income strategies come into play. I'm doing this video while the market's open, and I'm meeting with clients while the market's open, and I can't be meeting with clients and managing your portfolios at the same time. So the reality is that that's what sound income strategies does, as they manage your portfolios, manage the investments in your portfolios while I'm meeting with clients, and yet they do that through me. You wouldn't even know that they're there if I didn't tell you, because they're behind the scenes that are the ones doing all the research and making all the decisions. And if you're not with sound income strategies, and 95% of you are, but if you're for some reason are not with sound income strategies, if I'm still managing your portfolio personally, let me know, because we need to change that. I think it'd be better. But call me and we'll certainly have a conversation about that. But Sound Income Strategies has done a phenomenal job in navigating this whole thing and being really just having foresight as to what's going to happen. You remember I put out a video about them back in, I think it was April, about all the research that they did when coronavirus hit, research on all the bonds. They did the cash burn analysis to figure out what bonds are good, what bonds are not. Their investment, their analysis proved that everything they had done up to this point had been just rock solid. So they've done a phenomenal job. Well, one of the things that they foresaw as well is the fact that yields were going to come down. It's just a matter of time. When we started printing all this money and when the 10-year treasury came down, I mean, at one point, the 10-year treasury was like 0.3%, a third of 1%. Now it's back up to 0.8%. But for sound income strategies, they knew that ultimately this would mean a lower yield. So they've really done a ton of research in the arena of BDCs, in the arena of REITs to try to get that yield up. And another thing that they've done, especially because we've had people that have asked, is they built an equity, or I should say are building a dividend equity portfolio. It's stocks that have income. And when I say that they've built, I want to clarify. I mean, they have the portfolio put together, but that's subject to change. Investments that they bought 2 months ago might get swapped out if they find something better. So this is not a static environment where everything just stays the same. This is a dynamic portfolio where right now with high quality stocks is yielding over 5%. So we're not leaving the income. If 43% of the S&P 500 total return came from dividends in the last 20 years, well, then a lot more of this stock portfolio is going to come from dividends as well, too, because the dividend across the board for the S&P 500 is only something like 1.25%, 1.33%. It's amazing that 1.33% accounted for something like 43% across the board of total return of the S&P 500 over the last 20 years. So imagine what 5% will do. So right now, as we speak, our equity dividend portfolio is yielding in the range of 5%. And you have to understand the amount of research that it takes to get a portfolio like that. The individual behind the scenes who actually is responsible, the head analyst who is actually responsible for putting and doing the initial research for putting equities in this portfolio has decades of experience in Wall Street. And he doesn't just go to motleyfool.com and Google an investment and realize that he wants to put it in the portfolio. What he does is he calls all of his analyst friends after doing initial research. He calls investors relations. Most, if not all, publicly traded companies have an investors relations department that you and I can't call as a retail investor, but they can call. He'll call them sometimes 2 or 3 times to get the information, and sometimes it takes him weeks to do all the research, just doing nothing but research on one company to find out whether or not that company is worth putting into this portfolio. So the reality is it's just research like crazy. And I've read some of the newsletters he's put out, some of the statistics. It would bore you to death, but very, very interesting. And the amount of research is just absolutely unfathomable before they ever put a stock into that portfolio. And what they're looking for is they're looking for value plays versus value traps. What's the difference? Well, value stock is a stock that really is lower than maybe it should be based on the price-earnings ratio and other ratios that our analysts use to determine whether a stock is good or not. So the reality is that a lot of stocks have come down, and the question is, are they down just because there's a legitimate reason for them to be down and we would expect them to go back up, or are they down because there's a fundamental problem with the company? This is huge. This is a very huge, hard decision. That's why most advisors don't specialize with value stocks. Most advisors are going to specialize in growth stocks. It's really so much easier to ride a growth and ride momentum and just buy the Googles and the Netflix and the Amazons and just buy those and just ride them up. That is a whole lot easier than trying to buy a value stock that is discounted. Because if a stock is priced here and pays a 2% dividend, right? Well, if that stock drops by 50% in value, and there's a lot of stocks in the S&P 500 that are down by 40 and 50% still, if that stock drops by 50% in value, well, the dividend is paid in terms of dollar amounts per share. So the yield went from 2% to 4%. And so when you go to look at that stock and you look at the 4% yield, it's very easy to say, oh, it's 4%. I'm going to buy that stock. It's 4%. Good dividend. So you buy the stock, and then what does a company do? They cut the dividend. And then it goes down, and then people buy the stock, and then they cut the dividend. That's a value trap. Great way to lose a lot of money if you don't know the difference. But there's a lot of companies that have come down where we don't expect, after all the research they've done, they don't expect them to cut the dividend, and they expect that maybe that profit, maybe the company's even going to climb back as well too. But to do that research is just very difficult. When you start doing searches for stocks that are yielding over 3.5%, you get under 100 companies very quickly. So it's just tough. Bottom line is sound income strategies, having the foresight of realizing where yields were going. Part of the reason why the stock market has also done well is because people on their own don't know where to go get income. I'm telling you that we're getting 4 to 5%. That's the target. Our target is to get you 4 to 5% net of fees. Let's put that out there. But if you try to do that on your own, you're probably not going to do it. Not without a lack of diversification. We've had clients all the time that we'll take on that will say we can only get 2 or 3% on our own. How are you guys getting 4 or 5? So you probably won't be able to get that in any type of a quality portfolio. I mean, you can buy a bunch of junk bonds that will give you that, but that's not what we're doing. So the reality is that 4 to 5% is our target, because yields are so low and because people are only able to get maybe a couple percent on their own, because there's no options for the retail investor, what do they do instead? They buy stocks. Well, that helps drive the stock market up. And that's part of what's been driving the stock market, because there's no viable alternative, not outside of dealing with a company that specializes in income. So the simple fact is that that's part of what's driven the market up. And a lot of you have asked, because we don't have a lot of headwinds for the market ahead of us for what seems to be like maybe the next year, a lot of you have asked about getting back in the market. So over the last 6 or 8 months, they've been developing an equity portfolio that yields over 5% and got a little bit of potential to grow as well too. So if you want to get some of your money, small percentage, 10%, 20%, whatever that means to you, if you're younger, maybe even a higher percentage in the equity portfolio, I would invite you to call me and let's have a quick conversation about that and see if it makes sense to make a change, to be just a little more aggressive, but still stay within the confines of income. So I wanted you all to know that that's available. That's something they've been working on. Sound Income Strategies has done. I've never been more proud of a company, period, than Sound Income Strategies. They've done phenomenal. And part of that is keeping pace with what's going on in the world and developing and managing an equity portfolio that pays high yield. That's a phenomenal win-win. So call me if, in fact, you want to have that discussion. Well, that's what I wanted to cover in this video. Hope it helped. Again, thank you for your business. And if you're not a client of ours, you want to have a quick conversation, our contact information is on our website, providencefinancialinc.com. God bless.